Hi, this is Randy Finney with the right side of the chart, and today is Thursday, August 1st, 2019. It is about 11:40 a.m. Eastern Time as I'm starting this video, and I wanted to do a quick update on broad markets for members. Kind of a follow-up. I just sent out a post a few minutes back on QQQ, XLK, and SPY, all back testing their uptrend lines. So to rehash, and again, my thoughts are in there. So I'd encourage you, if you're listening to this video, you probably already saw that post. And as I said, the breakdowns yesterday, although they were certainly impulsive, they are suspect because it was Fed induced. And again, I've seen this movie played dozens and dozens of times before in the past, where you have a market moving, a well anticipated FOMC meeting announcement, and you get these knee-jerk reactions that are not the lasting reaction. Sometimes they are. So again, we had, and as I said in that post, the technicals were, and more importantly still are, indicating, doesn't guarantee, but they're indicating that a correction or major trend reversal correction is very likely. And as I said back here in those other videos and updates, that can go on for some time. You can have divergences, negative breadth indicators, things like that just continue to build. We had a divergent high at that point, and we went up a little more, and divergences finally played out for what they usually do, and that is a trend reversal. Big divergences usually equal big corrections. So, with all that being said, again, I said, because of the fact that yesterday's breakdowns may have a good chance of proving to be whipsaw signals, and as I say often, the fewer things in trading and investing are more bearish than a failed downside or bearish breakdown. In other words, that's what happened today. You look at the charts, you can see that the bulls have recovered almost to the penny. Here's where, there was 2 o'clock right here. I have that this right here was a 2 o'clock candle. We're exactly where we were. See down below when the Fed announced, made the announcement at 2 p.m. There it is. Sorry, there's the 2 p.m. the hour break line right there. So we're right about there. And if you zoom in tight, whatever, it doesn't matter. We had a little spike up. This was before the meeting. So yeah, exactly there. Anyway, back to the chart. So what they've done is, they've reversed that. Now we haven't gone up higher yet. I'm going to show you some levels to watch. So again, let's keep it simple. The breakdown, again, you have to take with a big grain or a lump of salt. And but again, from a technical perspective, a breakdown to backtest, that's an objective place to add. And if we didn't have, again, the charts weren't already indicating these bearish patterns, I wouldn't even consider it. In fact, I'd probably be going long off that false breakdown because it's, that's a bullish technical event when you have a failed breakdown that's recovered. But right now we're backtesting, as I mentioned in that update. And again, these are daily charts. It's okay if you zoom in tight and you see the candle a little bit above. You can play around. I could tighten this trend line up, certainly a little bit like that. For all intents and purposes, we're there. Remember, daily charts, especially on a day, we've had volatility finally expand. We're coming off not a record low, but record for one of the lowest periods of volatility ever that we've had, and certainly the lowest since back here leading up to that top. And so now volatility has woken back up. It's expanded. Volatility cuts both ways. It doesn't only mean to the downside. You can see XLK is up 2.23, and you can just look at the candle. Look at the size of the green candle relative to all the other candles. So where am I going with that? Well, support and resistance levels, especially if you're trading a daily chart, are very likely to get crossed through on a daily basis. So the fact that we're a little bit above it now doesn't mean much at all to me. It's where you close today. You print a solid close back above the trend line, then I will say with certainty that was a failed breakout, that false whipsaw signal if we close solidly back above the uptrend line. But let's see how the day finishes. So that's it. And as I said in there, certainly aggressive to short. I would not go to a full short position. And again, I've said this in a recent video. To me, a full short position, if I decide I'm going to short QQQ or XLK or SPY, that does not mean my entire portfolio, not even close. It's not 100%. It's just, every position, and there's no set number. I might determine, if I'm going to go long the let's just say the shipping sector. I might say, okay, well, shippers are volatile, but there's a lot of risk reward. And depending on what else is going on, how else my portfolio is positioned, I might say, okay, I want a 10 or 15% stake in the shipping stocks. And then I drill down in there and know what are my favorites, within there, and I'll spread that around. So on the broad market, like I said, we don't even have any solid sell signals yet, and we're still above those breakouts from back in April. And so until and unless these go, all the indexes, including XLK, the tech sector here, had major tops back in April of 2019, and then they came up, tested them for a while and broke out. So this is the breakout, which is still very much intact, as I've covered in recent videos. So step one for the bearish case would be a rejection here soon, and a move back down to undercut yesterday's lows. And then step two would be a break, not a little whippy intraday thing or brief pop 1 or 2 days below, but an impulsive move, solid close. The more candles, as I like to say, the redder the better down below through there. So that would be phase two, and that would then be, at my point, a high probability sell signal on the markets or on XLK. And as I always say, you want to see it happen on all of them, not just one. So if SPY were to do that, you want to see XLK or QQQ follow suit as well. And there's the back test on SPY. So we'll leave it at that. I'll let you guys decide if you want to take a fairly aggressive partial position there or not, but it certainly does not meet the criteria for an official trade. It's speculative, and again, it's only at most, I think, just a take a starter position. Market keeps running up, you get stopped out and you don't have a full position. So it's, even if you give yourself a 5% stop loss on a 1/4 size position, you're talking 1-2% on what what you might lose on a normal position size trade. So there it is, and there's the levels that SPY needs to break. IWM, we have that confluence of resistance and support right here. What stands out, the trend line, downtrend line on IWM right there. We popped it yesterday, but again, it was on that Fed-induced move. Ran right up to my first resistance. I've highlighted this level recently on IWM. I had meant to cover this chart yesterday when I did the closing market wrap video. I never did. So we ran up to the 159.40-ish area, reversed after the FOMC meeting, and we're struggling. We're a little bit above there. You really zoom in tight, but not by a lot. It's not an impulsive breakout yet. You had a big volume bar yesterday because that was the FOMC, but then you came back down. And so that's where we're at now, kind of stuck between a rock and a hard place, support and resistance. Support being the trend line below. So I can tell you don't have really any sell signals, and you won't on IWM until, number one, you need to fall back impulsively below this uptrend or downtrend line I just colored blue. Second, you need to then break this uptrend line, this minor uptrend line off the lows. So together these form this sort of symmetrical triangle pattern. And so again, the IWM small caps are pinched between resistance. If they can pop 159.50-ish, we'll call it 160 to be safe. If they can pop it with conviction, you do have a little reaction high up there, but that would be bullish. And that would also, when I look at this, let me show you one other line I want to put on this chart for you if you're a small cap trader. I can show you that we have some divergence, negative divergence. It's not very big, but small divergence right there that gives us this rising wedge type pattern. So, and again, like any pattern, it's bearish by nature, but it is not a actionable trade. There's not a sell signal. It's only a potential bearish pattern if it breaks down, and it would have to trigger that. So if that happens soon, it would keep these divergences intact, and that would give you a sell signal on a break there on IWM. However, if we continue to go up, if the breakout above this downtrend line holds and we zigzag up, we take out 159.41, what will happen is a couple things. It'll take out or negate these divergences. Why? Because then you'll have higher highs on the indicators along with higher highs in prices. You won't have the lower highs, and that's what gives you the negative divergence there. Equal or lower highs with prices making higher highs. The other thing is, this trend line then would still have still be valid. So you would just look something like this. Maybe you break out, then you come back in for a back test later. So if you're bullish, these are levels, and I do this when I when I go over the charts. If I have an opinion, I will give you one. On that, if you're a gold member, and that's one of the benefits of a gold membership, is that you can, in the trading room, ask me my 2 cents on any stocks, positions that you have, positions that you're considering, and I'll give you my opinion. However, a lot of times you'll notice that I tell you I don't have a good read on the chart or an opinion on the stock. I'll tell you to be careful of anybody that does always have an opinion on the market and is certain where the market or a stock is going. I would run, not walk away from that person, because nobody knows, not even the smartest guys in the street. And they'll tell you, that there's a lot of uncertainties in the market, and anything can and will happen. And again, with an individual stock. In fact, it was Bertrand Russell who said the whole problem with the world is that fools and fanatics are always so certain of themselves, and wiser people so full of doubts. So, again, be careful of the person that tells you the market or this stock or something is definitely going to do this, definitely going to do that. But if what I can tell you are where the key levels are, and I'll always share my opinion if I have one. So if I'm bullish or bearish at the time, I'll tell you. But you can trade off. The takeaway is you might see things. You might be bullish when I'm bearish, and let's say in IWM that was the case. So right now I told you I'm kind of neutral on this one. We're there. I told you the levels that would trigger a sell signal. Favor that right now. I'll tell you I favor it, but not enough to. I don't even have any positions in this at the moment, or any small cap futures or anything. But again, if you are bullish, then you could look to go long on a breakout there, or if we get a pullback to that trend line or resistance, once broken, becomes support. So that's the takeaway of my analysis is I highlight the levels. That's where I think my skill sets lie, or primarily is identifying important support, resistance levels, trend lines, things that other people may not see that are likely to come into play, and whether the stock bounces off that trend line or not. Longs can buy pullbacks to a trend line until the trend ends, and then the hard part, or I think it's not so hard, is identifying when the trend's likely to come to an end, and those are things that I incorporate into my trading, such as divergences, overbought conditions, rallies into resistance. If you're walking up an uptrend line, you don't buy the pullback to the trend line when you have major support just overhead, because the stock is then likely to hit that support and reverse. So there's a lot that goes into trading, but that's some of it. So back to the big caps, because I just wanted to do this market update. So there it is. We're at back testing those levels. Again, it's objective, in my opinion. Objective doesn't guarantee it'll play out, nor does objective mean high probability short entry. Please understand, objective simply means that. It's objective. What's not objective? The opposite of objective would be just a pot shot anywhere in the middle of this range. If you're in between support and resistance, or you can't make a case to go long or short based on a trend or indicators that might there's two ways. You can either trade a trend, just keep buying the pullbacks. Obviously you can randomly buy pullbacks. That's what people call buy the dip, or BFTD, BT, whatever, buy the F and dip. Or you can do it the smart way, which is strategically buy dips, pullbacks to support. That's probably the wrong chart to show you what I'm talking about, but that would be a pullback to a well-defined price support level, or a well-defined uptrend line, maybe a key Fibonacci retracement level, something like that. So that's what trading is all about, guys. Formulating your opinion on a stock, the market, a sector, and then use technical analysis to identify. This is again my trading style. Some people trade off candlesticks, various candlestick patterns, Fibonacci's, Elliott wave, all kinds. There's all kinds of disciplines within the TA arena. My style, as you probably have noticed, largely includes support, resistance levels, trend lines, bullish and bearish chart patterns, divergences, and other things. Volume, a lot goes into that, and so let's just stop it there and go down to the 1 minute chart. This is what I wanted to share with you. Okay, so I showed you a minute ago on the daily charts that we're back testing or relatively, right around those trend lines, and that's an objective short entry. But let's say you like that. You're intrigued by it. You would like to add some short exposure, but the market's going up, and you don't want to add while we're still going up. So where can you hone down your entry exits? In the trading room today, I posted a couple. I used the futures. You know what? I can even pull those charts for you. Hold on one second here. Okay, so on that trading room post, I don't know, it was an hour or more ago, I said, wait for it, wait for it, wait for it, and said, look, this would be, if you're a day trader or a swing trader, for day trading op, here's the NQ and ES, and again, it's not time stamped here, these are small little 1 minute charts I have, break of these 1 minute uptrend lines, and I said, but ideally in conjunction with a back test of those trend lines or resistance levels that I laid out earlier on the 60-minute charts, the SPY and QQQ, or NQ, and ES, NQ, SPY, and QQQ. Why? Because I said if we broke down before we hit those key resistance levels, you'd likely get a breakdown and then a back test, another kick up higher. But if you run into, on those more important 60-minute and daily charts that I just showed you, where we're at now, resistance, then you break these trend lines. This is when I say sharpening my pencil or trying to hone down an entry. This is the timing of it. When these trend lines on the futures break, they're fairly clear 1 minute uptrend lines. Again, those were about an hour or so ago. Let me show you how those look now. Okay, they're down here on the bottom of the monitor. I had to move the screen capture. This is a big old 32-inch monitor with lots of many different charts and on here. But down here on the very bottom here, let me get this one out of the way for you right here, so we can see. There you can see NQ, ES, and these are those same charts I just showed you before. So I'm going to replicate those same trend lines. That would be right there, and you have a trend line. I think that's how I had them drawn there. There's, you can see it's sort of a smaller trend line right there. I had that on the SPY chart. But either way, these are, any way you want to slice them or dice them, these guys are broken now. And you can see they're broken, and now we have the second most. This is about tied with this one. We had impulsive selling there. We had a very minor trend line. But so far, and again, these are just streaming 1 minute charts as I'm doing this, you can see that we've broken down, and it's not just that we went below those trend lines. What happened? We didn't go sideways or limp around. We started moving impulsively lower, and we're still, as I'm doing the video right now, you can see. So that's the timing of it. So if you didn't want to short here, I did the kind of broad brush strokes with the daily charts, because as I said, on a daily chart, and with volatility, you're going to move up, and it's you're not going to hit that trend line to the penny. You can sit here all day long and pull your trend line around on the daily chart. This is a 1 minute up here, but all right. So you get the point there, and that's, again, those are things that I look for in trading is, formulate the bigger picture with the longer term charts. That would be your, depending on your time frame, the weeklies, the dailies, for example, that kickback to resistance, and then hone down here on the 60-minute charts. These are the charts I posted this morning in the trading room. I'm sorry, on the front page of the site. You've already seen this SPY hourly chart. So that's exactly what I said over an hour ago in the trading room when I posted those 1 minute charts of the futures. I said, there's going to trigger your sell signal there. You can either take it as a day trade. If you day trade, you leverage up because there's no overnight risk. So you take, to me, 5 times or more what I would take on a swing trade position, and therefore you can get a quarter point on the SPY or ES or NQ, a quarter percentage point. You're making pretty decent amount for a day trade, and again, since you don't have the overnight risk and the risk of a sudden opening gap, that's why you can take a much larger position, 5-10 times. That's up to you what you might normally take on a swing trade, and therefore you get those little cuts. If you get a 1-2% profit on a day trade, that's big, and that's what we had yesterday on the natural gas. So the point was, there it is. There's the downtrend line. So I bring it right in to catch all the candles. So I'm talking about tightening it up. We hit it to the penny. You cannot make this up. That candle, the top of that candle, the top of that candle, and that's where we were today. So there was your objective entry on the pushback to the downtrend line, and then further confirmed right after that by the break of those 1 minute trend lines, and that's what I call honing down an exit on a stopping a trade. QQQ, we went a little bit above it, and let me show you QQQ futures. Well, I should say NQ. NQ are the E-mini futures for the NASDAQ 100. And this, again, guys, is why I post all these charts. You might wonder, well, why don't you just post QQQ? I like to trade that one. Because, you know, a lot of professionals, and what I trade most often are futures, but then I'll also watch, during the regular session, there's more volume, a lot more people trading QQQ. So I'll watch them both. And so whereas I just showed you, you know, that downtrend line was taken out on QQQ as well as NQ here, guess what? At the same very moment that we reversed, ES and SPY hit their trend lines. And that is why I say, even if I'm only trading NQ, I will not trade it in a vacuum. Only looking at the charts of NQ, I will look at the charts of the, you know, you can look at the Dow if you want. You know, too many things, it gets complicated. It's like trying to hold sand in your hands. You're going to lose some. Plus the Dow's only 30 stocks. So my two big cap indexes are NQ and ES and SPY. And so you can see at that point that NQ reverse was exactly when SPY hit that downtrend line. And also, not by coincidence, there's that level I posted earlier today in the same chart, 8,801.50, because remember NQ rounds off in quarter point increments. This charting platform, for order you drag the lines, they won't snap to the nearest quarter point. So that would be, and that's about where we reversed. We had a, you know, I always say this, I call it momentum fueled overshoot. This is a vertical, this is a rocket, straight up move. So we had what would almost be expected is a slight overshoot, brief overshoot of the actual resistance level that we were going to stop at, which was my uppermost resistance level on this chart. Again, posted earlier today, hit that, and boom, we reversed. So to me, look, we can go right on through there, and then this whole 20 minutes I've just been talking is all moot. We just keep going, but that's trading. So that's an objective entry. That's where you can add on or enter a either a day trade or a swing short, and again with a stop above. You know, whether you want to put it above the recent highs, I can't tell you where to put your stop because it all depends on what you're doing. If you're a day trader and you're looking for a pullback to this, let's say back test this downtrend line, or a pullback to this uptrend line right here, then that's a very small profit. That's, you know, certainly lucrative for a day trade, trading futures, but you want a more aggressive stop. If you're a swing trader, and again, let's loop back to the daily charts, and you're saying, you know what, Randy, I understand the you know, the odds are not as good as they would be on a normal trade, but I like it, so I'm going to short this back test for a swing down, you know, let's say all the way back here or a lot lower. Then you can use a much larger stop. Stops should be commensurate with your price target. Ideally, I like to use a 3-to-1 or better risk-reward ratio, meaning I will risk $1 of loss for every $3 of profit potential I'm shooting for. So, you know, if you're swinging for the fences and you think this is a top, there's not enough evidence right now I can say that for a top. So let's not talk about the 25% plus downside. That may come, maybe not. There's just, first things first, let's get some solid sell signals here on the daily. So let's just talk swing trading. I'd say a pullback down here. I told you I'd sharpen my pencil. I'll give you some targets today, but let's just say a pullback to 185.70, and that would be a, from where we're at right now, measuring tool, grab the highs, come down. That'd be almost a 5% drop. So, you know, you can give yourself a 1.5% or so stop loss on that type of swing trade. Maybe even tighter. You can, you know, the better your RR, the better it is. You know, use a 5-to-1 risk-reward ratio. However, just keep in mind that you're running the risk, the chance of being stopped out more. The wider the stop you use, the less chance you're going to be stopped out on just the grind. And remember, again, volatility has woken up now. Finally, it's perked up. I'll wrap this video up just by looking at the VIX. We had a breakout right here, and this is not by coincidence, guys. I've seen this time and time and time again. The VIX is certainly not a perfect inverse or mirror of the stock market, but it tends to move inversely, especially with the big corrections. And so where I'm going with this, I have had this trend line here. This was before yesterday. You can see it was last updated 7/29 or whatever, before the FOMC meeting. And so where I'm going with this is, it is far from coincidence that the downtrend line that I had on the VIX coincided perfectly, the breakout above it, and big impulsive move coincided perfectly with the breakdown yesterday on all those trend lines I just showed you on SPY, QQQ, and XLK. And nor is it coincidence that we're coming in fact, let me tighten it up a little bit here. You can see a couple reaction highs right there, right there. Again, you can play around a little bit, but so there's the inverse of what happened in the stock market. We had a breakdown with an impulsive candle yesterday. You had a breakout with an impulsive candle, and now the VIX is back testing. So what does this tell me? It confirms or aligns with exactly what I'm seeing on the market. That, hey, maybe that was a Fed-induced whipsaw signal, but you take the charts for what they are, and sometimes I'll tell you, my best trades, that's what I do. I don't second guess. Take the charts for what they are, and over time you'll do well. That is then a back test and offering an objective long entry for something. You can't trade the VIX directly. You have to use VIX futures, options on the VIX futures, or one of the ETNs that will then invest in the options. This is just one of several. I like to, this is one I'll use in IRAs and things sometimes if I don't use the options or the futures. There it is. That was the last trade, but there it is. You can see still setting up, and to kind of hone in on this because I know there's always a lot of buzz on TVIX. I'm not going to add this one on until we have some higher probability sell signals, but there it is. See that nice clean downtrend line I just added right off the highs? Boom, 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 boom. There's a breakout back test similar to the VIX. So again, and you also have a little mild support. So I'll tell you an objective entry, albeit a little bit aggressive, but there it is. And if it holds, we back test, we're going to take off. This might be the last chance. Yesterday's breakout being the first objective entry, although again questionable because of the Fed, and now a back test. So, and that's TA 101. If you're going to take a trade like this, a bullish falling wedge breakout, I just noticed I didn't have this chart all the way in there. There are two objective entries. You go long on the breakout, or you go long on the back test. And with a stop somewhat below. Back test, as I said, a little tough because trend lines are dynamic. You can continue to back test. And with TVIX, you don't want to do that because this sucker is decay central. If you hold it for a long period of time, the decay will just eat you alive. The VIX has a lower end of the range, but TVIX does not. TVIX will always, over time, lose value, whereas you can go back here. This is a decade on VIX. And you can see the VIX will always come down to a lower end of the range because the VIX is, it's a theoretical index. It's not. This is a spot VIX. You can't trade it again, but the VIX tracking ETNs, they suffer from decay. And when you look at again, that's the VIX. You can see, bounced around. The low end of the range for the past decade here has been around roughly, barring that brief spike there, around 1150 or so right here. But when you look at TVIX. Long-term chart, it's just plain ugly, and this is guaranteed to happen. And somebody even asked me if we go in a bear market, yeah, you're still going to see, over time there's going to be some big runs, but this decay will even kick into effect during a bear market, especially if we get a prolonged bear market like I think the next one will be. Instead of 18 months or so like the last one, I think it'll be more of a long drawn out one. And so you don't want to, point is, you don't want to tuck away TVIX or any of these VIX ETNs as a long-term hold. They are strategic, more so, I'm sorry, not strategic, tactical trading vehicles. Hit and run. Get in, get out. See these divergent lows, see the falling wedges, go long on the breakout only when it confirms with a breakdown in the broad market, divergent low, boom. And that's what we have down here, divergent low once again. So there it is. Let me stop here. It's a long video, but again, these are the times you want to get these out there because right now I imagine the masses, especially bears, have just given up. They feel like they've probably been gut punched right now with this recovery rally, and it may prove to be an objective short entry, maybe not. But I shared my thoughts, and I'll let you guys decide what you want to do, and I will most certainly follow up. Especially if we get some confirmation to the downside. If we just continue to grind higher, then there's not much to update. All of a sudden, slowly but surely the bearish setup, at least that we have right now, will begin to dissipate if we recover those trend lines like I just showed you on the indexes. But until and unless we do, there's a potential right now for still for a reversal and another big drop in the markets despite today's strong rally. We'll end it here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.